All right, let's dive into the world of industrial software. We're looking at two of the heavyweights today, Autodesk and PTC. Now, on the surface, they might seem similar, but when you dig into the numbers, you'll find they are on completely different journeys. We're going to put them head to head, break down the financials, and figure out what the real investment story is for each one. Let's get right into it.
So first, let's get the lay of the land. Take a look at this chart. Over the last 5 years, the Nasdaq has just been on an absolute tear, right? It's up over 80%. But look at industrial software during that same period. It's kind of been left behind. PTC has seen some decent gains, but Autodesk, wow, it's basically been dead money, actually down almost 14%. Now for an analyst, this kind of gap, this is where things get interesting. It makes you wonder if there's a mispricing or maybe a hidden opportunity just waiting to be found.
And this really sets up a classic Wall Street showdown. In one corner, you've got Autodesk, the established giant. You can think of it as the margin king. It's your stable, defensive player. And in the other corner, you have PTC, the growth challenger, a much more aggressive bet on some serious forward momentum. So the choice is pretty clear. Are you looking for stability or are you looking for velocity?
Okay, first up, let's talk about growth versus sheer scale. We're going to look at the top-line revenue just to get a sense of how big these businesses really are and where they're headed.
And this chart illustrates that size difference perfectly. I mean, Autodesk is an absolute behemoth. It's pulling in more than double the quarterly revenue of PTC. You can see that steady, powerful climb on the left. But, and this is the important part, look very closely at PTC's chart on the right. See that sharp kick upwards in the last quarter? That's what we're calling breakout velocity. It's a huge inflection point that tells us something fundamental has just changed for them.
But you know, revenue only tells you half the story. Now we get to the really good stuff, profitability. And trust me, this is where the investment case for these two companies really starts to split apart.
Okay, what's so incredible about this slide is that it shows Autodesk's massive competitive advantage. A 91% gross margin, that is absolutely elite. It screams pricing power. But you know what? The real story here isn't that stable blue line. It's the green one. Just look at how PTC has been grinding, relentlessly improving its efficiency and closing that margin gap. They're proving they can play at a nearly elite level too.
And if you thought that last slide was interesting, well, this one is the main event. This chart right here is the smoking gun for anyone who's bullish on PTC. While Autodesk just keeps chugging along with its predictable mid-20s profit margins, look at what PTC just did. That is a massive, almost vertical spike. It's like they flipped a switch and unlocked a whole new level of profitability. This is operating leverage in action.
53.6%. Just let that number sink in for a second. That isn't just a good quarter. That's a fundamental change in the entire company's ability to generate cash. This is the kind of number that makes everyone on Wall Street stop what they're doing and pay attention.
So how do we actually grade this kind of performance? Well, in the software industry, there's a key benchmark we all use called the Rule of 40. It's a really simple health check. You take a company's revenue growth percentage, add its profit margin percentage, and if it's over 40, you've got a high-performing company. It's basically the gold standard for balancing fast growth with making money.
And this chart just lays it all out beautifully. Autodesk is a solid business, no doubt. It's sitting right there on that Rule of 40 line. Good, but not amazing. But PTC? Fueled by that insane profitability spike we just saw, they aren't just meeting the benchmark, they are absolutely crushing it. This puts them in a truly elite class of software companies right now.
Okay, so we've got one company with massive scale and another with exploding profitability. So the all-important question for any investor is, what's the price? How much is the market going to charge you to buy into each of these stories? Let's take a look at the valuation.
And you know, when we look at the price tag, the plot thickens. You would think the company with all the new momentum would be the expensive one, right? Well, the market is valuing these two very, very differently. As you can see, the gap here is pretty striking.
Let's just put the hard numbers on it. Autodesk is trading at a really high-end multiple, over 51 times its earnings. Meanwhile, PTC, despite all that incredible margin acceleration we just saw, is trading at just 27 times earnings. That's nearly half the price. So let's be crystal clear. As an investor, you're potentially getting this powerful growth and efficiency story at a huge discount to the big, established player.
So it's time to bring it all home for the final verdict. We're going to look at how each company uses its cash, and then we're going to weigh all the key risks and rewards to see where we land.
First up, what do they do with their money? Autodesk is very shareholder-friendly in a traditional sense. They return hundreds of millions of dollars to investors through stock buybacks, which helps prop up the stock price. PTC, on the other hand, has been taking a different approach. They're plowing that cash back into the business to make it stronger from the inside out. And specifically, they're cleaning up their balance sheet.
And here is the beautiful result of that strategy. I mean, look at this transformation. A few years ago, a big risk for PTC was its high debt load. Well, today, that risk has been systematically wiped out. They've aggressively paid down their debt, and now their balance sheet is way cleaner than Autodesk's, which is still carrying a pretty high 2.87 debt-to-equity ratio. That's a huge de-risking event for PTC.
Okay, but let's be real, no investment is a slam dunk. For Autodesk, the biggest risk is pretty obvious, that high valuation. At 51 times earnings, it's priced for absolute perfection, leaving very little room for error. For PTC, the risk is all about execution. Can they keep up that incredible margin performance? And for both companies, there's the bigger picture. What if the market just stays cool on industrial software and keeps favoring other parts of the tech sector?
And that really brings us to the bottom line. This image just sums up the entire choice perfectly. On one side of the scale, you have Autodesk. It's like a bond proxy. You're buying stability, a huge competitive moat, and you're focused on preserving your capital. On the other side, you have PTC, which is a pure alpha play. You're betting on accelerating growth, margin expansion, and a cleaner balance sheet, all at what looks like a very reasonable price.
So ultimately, the choice here really depends on your own personal investment strategy and how much risk you're comfortable with. Are you looking for the steady, predictable giant that's built to last? Or do you want the faster-moving challenger that looks like it has just hit its stride? The bond proxy or the alpha play? That's the question you have to answer for your portfolio.